Our next guest, keen on strong engagement and higher industry pricing. Alan Gould from Loop Capital joins us. Has a buy rating on the stock. Price target 700. Alan, good to have you here.
Nice.
What are the trends that give you confidence going into the earnings print where you think it's going to be a good one?
Yeah, two things. Number one, Nielsen comes out with some monthly data on share of television consumption. Netflix was at almost 8% this quarter, second best quarter they've had. Secondly, Netflix has started giving out weekly data on the top 40 shows or top 10 shows in 4 genres, and that trend's been straight up since November.
The commentary on the call can often sort of whipsaw the stock,
Sure.
Particularly if it comes to something like margins or content spend. What are your expectations there, particularly when it comes to margins?
I think margins will go up again. I mean, so last quarter, which was in the first quarter of the year conference call, they raised their guidance on margins from a 22 to 23% range to 24%. It's very unusual for a company to be raising guidance the very first quarter of the call, the first quarter of the year. If you look what's happened, the sub expectations are higher, which means revenue will be higher. If you have higher revenue on the same cost basis, you should have higher margins. Also, Netflix's biggest cost is its cost of its content, and it amortizes that content over 3 to 4 years. So about 2/3 of the cost for the year is already known because it's based on the content they bought in prior years. And as you know, we had the strike last year, so they didn't buy as much. So I think margins go up this year.
What do you think's happening in their film strategy? There's been some executive shuffling. Everyone's talking about the Tyson fight. I mean, are they really trying to change the direction of the boat?
Well, film hasn't worked for them that much. I mean, if you look, Netflix's TV shows are what everyone talks about. Very few people are talking about Netflix's films. So they were spending a lot of money. They were producing a lot of films. They're going to spend less, produce fewer films. Yeah, eventually they're going to get a film that is the same quality as a Stranger Things or gets the same hype as a Stranger Things. But they just haven't succeeded on that yet.
Is it still hit-driven with the shows and with the subscriber numbers, and what's fueling it for them right now?
It is to some degree hit-driven. Netflix, to me, is less hit-driven than the other streaming services just because they have so much content. There's always something for somebody there. This quarter, they actually had a few shows that were quite strong. So, yeah, the hits certainly help.
Obviously, the domestic sub numbers are not really expected to grow very much. It's more about international. So what are your expectations in terms of the numbers they may put up there?
Yeah, so we're at 5 million sub increase for the quarter. I think some of the whisper numbers on the buy side is as high as 7 or 8 million subs. Keep in mind, Netflix instituted its charging for password sharing in 2Q last year. And then 2Q, 3Q, and 4Q, they beat the street's numbers by about 4 million subs each. This will be the last sort of easy quarter on that. And by the way, they are still benefiting from the crackdown on password sharing, because first it was just on the TV sets. Now they're cracking down on mobile. So there is a glide path here.
Alan, appreciate your coming by. Thank you.
Thank you.